The global silver market is not just about glittering jewelry or shiny coins. It's a battlefield where supply chains meet geopolitics, and one country holds the most powerful weapon, the refinery. While silver is mined all over the world, from Peru to Mexico to Australia, the critical step that turns raw concentrate into usable, high-purity, refined metal has long been dominated by China. Estimates place China's share of global silver refining capacity at 60 to 70%, a concentration that gives Beijing extraordinary leverage. This isn't about owning the mines, it's about controlling the processing stage, the refinery bottleneck that determines who gets the finished product. On January 1, 2026, China activated a new export licensing system for refined silver, a move announced months earlier but now fully enforced. Exporters must obtain government licenses from the Ministry of Commerce, MOFCOM, with strict eligibility criteria, a minimum annual production of around 80 tons, and substantial credit lines, often cited as $30 million or more. In late December 2025, China released a list of just 44 approved companies for 2026 to 2027 exports, mostly large, state-aligned firms. This effectively sidelines hundreds of smaller and mid-sized refiners that previously supplied international markets. The result? A wave of cancellations and denials hitting Western buyers almost immediately. Industrial purchasers in the US, Europe, and elsewhere report receiving blunt emails. Cannot ship. License not qualified, or awaiting approval, timeline uncertain. Relationships built over decades don't override policy. This isn't a full ban, yet, but it's a selective filter, granting Beijing veto power over every shipment. Why does this matter so profoundly? Because the world didn't just rely on China for cheap silver. It built its entire industrial ecosystem around reliable flows from Chinese refineries. Silver isn't like oil, where you can switch suppliers quickly. Refining is capital-intensive, heavily regulated, and requires specialized expertise. Building new capacity outside China takes years, not months. Permits, feedstock agreements, environmental compliance, and massive investment all add up to multi-year delays. In the short term, the market is scrambling. Non-Chinese refiners in places like India, Japan, or the US are suddenly flooded with orders, leading to extended lead times, weeks turning into months, and skyrocketing physical premiums. As of early January 2026, reports from dealers and analysts show physical silver trading at significant markups over the paper spot price. Spot silver has surged past $70 to $80 per ounce in some sessions, but physical delivery quotes for industrial-grade bars or grain can command 30 to 50% premiums or more in tight markets. Dealers aren't being greedy, they're protecting themselves. If they sell inventory at yesterday's price, but can't replace it affordably, they're effectively giving metal away. This divergence between paper and physical markets exposes a core vulnerability. Futures exchanges like COMEX trade paper silver, contracts that can be settled in cash or rolled over indefinitely. But factories can't run on paper. Solar panel manufacturers need silver paste for photovoltaic cells. Electronics firms require it for conductive soldering. Electric vehicle batteries and medical devices depend on its unique properties: high conductivity, antibacterial qualities, and reflectivity. There's no easy substitute. Industrial demand now accounts for over half of global silver consumption, driven by the green energy transition, 5G rollout, and AI data centers. When Chinese exports slow, these must-have buyers don't wait for lower prices. They bid higher to secure whatever's available. This forces rationing through price. Weaker demand, like jewelry or silverware, gets priced out first, while strategic sectors, solar, defense, automotive, pay whatever it takes. The result is explosive premiums and eventually upward pressure on the spot price itself as paper traders rush to catch up. Geopolitically, this is no accident. China has used similar playbook with rare earths, graphite, and gallium, elevating commodities to strategic status and using export controls for leverage. Silver's inclusion echoes that. It's vital for solar. China dominates global panel production, semiconductors, and defense applications. By prioritizing domestic needs, China's own booming solar and EV industries, Beijing ensures its factories stay fed while Western ones scramble. Early signs of strain are already visible. In Shanghai, physical silver has traded at premiums over Western benchmarks, signaling domestic hoarding. Global inventories at exchanges like COMEX and LBMA have been drawn down sharply in recent years, with structural deficits persisting for half a decade. The new restrictions accelerate this drain. Industrial buyers are shifting behavior, stockpiling where possible, locking in long-term contracts, or even exploring upstream investments in mining. For investors and observers, this creates asymmetry. If restrictions ease, perhaps for diplomatic reasons, premiums could compress quickly. But if they tighten or approvals become highly selective, the shortage could deepen into multi-quarter pain. Markets price the near term aggressively, so volatility is guaranteed. The broader implication is profound. Silver is transitioning from a mere precious metal to a critical strategic resource. Supply chains are becoming politicized. Factories in the West now face not just higher costs, but uncertainty. Will the next shipment arrive? This political premium adds to financial ones, pushing effective costs even higher. As we move deeper into 2026, watch key indicators: lead time from alternative refiners, premium levels on physical bars, denial rates in supplier communications, and policy language from Beijing. The war isn't loud with bans, it's silent, fought through licenses and approvals. But the consequences are anything but quiet. Physical scarcity is reasserting itself, and the refinery gate controlled by China is the choke point that could redefine the entire market. In this new era, treating silver purely as a monetary hedge misses the point. It's a supply chain metal first, with industrial demand setting the floor. When that floor is threatened by geopolitical control, prices don't just rise, they restructure. The silent war over refineries has begun, and the global economy is on the front lines.